disposal of interest. And actually, we say disposal of interest is whereby the parent company has sold some of the shares, or basically all the shares which are held in a subsidiary. So I think we did a question on partial disposal, but because of time, we are going to do another question on that, but not now. During our revision, we're going to do a question on full disposal, because in terms of how we prepare the group accounts, whereby we have a full disposal, I hope you can be able to recall what we said. We account for a subsidiary which has been fully disposed as a discontinued operation. We have to compute its profit or loss before it was disposed, and also the profit or loss arising from the disposal. And actually, we said that one should be recognized as a separate item within the consolidated statement of financial position. So during our revision, automatically we're going to do a question on full disposal. So make sure you remind me on the same during our revision. So today I want us to basically proceed, and we look on this. I think should be the last concept before we look on the group cash flow. I want us to look on what is known as the overseas. Overseas, in other terms, we refer to this as a foreign subsidiary. A foreign subsidiary, and in this case, the standard which is applicable here is International Accounting Standard number 21, IAS 21, overseas, or basically a foreign subsidiary. So first of all, we need to ask ourselves here, what is an overseas, or basically what is a foreign subsidiary? So this basically a subsidiary which is operating in a country different from the parent company countries of operation. Like in this case, we may be told that a company which is sitting in a country different from the parent company country of operation. Country of what? Of operation. Country of operation. For example, in this case, we may be told that a company which is operating in Kenya basically has acquired a subsidiary which is, for example, operating in what? In Rwanda. So the parent company operating in Kenya, the subsidiary is operating in what? In Rwanda. So this is basically a foreign, or basically overseas what? A subsidiary. Now in this case, or basically overseas what? A subsidiary. Now in this case, how do we prepare the group account here? The first thing which is important for us to appreciate here is that the Kenyan currency basically is the Kenyan shillings. What is the name of the currency for Rwanda? The currency for Rwanda is known as what? Who can tell us here? The currency for Rwanda. The currency for Rwanda is known as what? Who can tell us? The currency for Rwanda is known as what? Who can tell us? The currency for Rwanda. So the currency for Rwanda is known as Rwandan franc. Is known as what? Rwandan franc. Just like if you go to TZ, their currency is Tanzania shillings. If you go to Uganda, their currency is Ugandan shillings. If you go to Rwanda, they use a currency known as Rwandan franc. Rwandan franc. So basically, you can see that these two companies here, they basically prepare their financial statement using a different currency, using a different what? Currency. So this one, the parent company prepares financial statement using the Kenyan shilling. This one using the Rwandan franc. It is obvious that if you are preparing the group account, there is no way you can do a direct consolidation. You can do a direct consolidation. You take the asset and liabilities, revenue and expenses of the two companies, you combine them. You can't do that because you can see those currencies are different. The financial statements of the parent company is prepared in Kenyan shillings, and the financial statements of the subsidiary are prepared in what? In Rwandan franc. So in this case, we are going to look on how do we translate. How do we do the translation? But even before we do that, we look on that, maybe there are some two terms we need to define here. One is something called a presentation currency, the presentation currency, and also something called the functional currency. The functional currency. So when talk about the presentation currency, this is basically the currency which is used by the parent company in preparing the group account. The currency used by the parent company, to prepare the group accounts, to prepare the group what? Account. In most of the cases, if the parent company is a Kenyan company, this one will be preparing the group account in Kenyan shillings. If the parent company is a Kenyan what? Company, it will be preparing the group accounts using the Kenyan what? Shillings. But that currency used by the parent company to prepare the group accounts is called the presentation currency. On the other hand, we talk about the functional currency. The functional currency, this is basically the currency, the currency of the primary economic environment, the primary economic environment in which a company operates, in which a company operates, in which a company do what? Operates. So basically that local currency of the country in which the company operates. So if the parent company is operating in Kenya, the functional currency is Kenyan shillings. If the subsidiary is operating in Rwanda, the functional currency or the local currency for that country is Rwandan what? Is Rwandan franc. So therefore, in this case, when preparing now the group accounts, we are saying, before you proceed basically to do the consolidation, before you proceed to add assets, liabilities, revenue, and expenses, those of the parent company, this particular foreign subsidiary, it is important for the financial statements of the foreign subsidiary to be translated into the presentation currency. Into the presentation what? Currency. Remember, you said the presentation currency is that particular currency which will be used by the parent company in preparing the group account. If the parent company is operating in Kenya, it will prepare the group account using what? The Kenyan shilling. So therefore, before we combine similar items of asset, liabilities, revenue, and expenses, those of the parent company, those of the foreign subsidiary, asset, liabilities, revenue, and expenses of this company, that is the foreign subsidiary, must be translated into Kenyan shillings, which is the presentation what? A currency. So how do we do the translation? These are the translation rules. These are the translation rules. These are of expenses. And remember, in this case, what we are translating are the incomes and expenses of this foreign subsidiary. So we translate them. They are translated. Items of incomes and expenses are translated using something called the average exchange rate. The average exchange what? The average exchange rate. Because in both of these particular questions for foreign subsidiary, you'll be given usually 3 exchange rates. You'll be the start of the year, the exchange rate at the end of the year, and also will be given the average. So in this case, we translate incomes and expenses of this foreign subsidiary using what? Using the average exchange rate. The average exchange rate. Number 2, when translating the asset and liabilities of the foreign subsidiary into a presentation currency, these ones are translated using the crossing exchange rate. The crossing exchange rate. This is actually the exchange rate at the end of the year. The exchange rate at the end of what? Of the year. So if you're able basically to know that, then this particular question or the question for preparation of group accounts whereby we have a foreign subsidiary, they become very, very simple. But it is obvious that in the process of translating the asset, liabilities, revenue, and expenses of this foreign subsidiary into a presentation currency, there is something which is known as the translation, or basically yes, the translation currency difference or exchange difference. In other terms, we refer to this as the currency translation difference. Currency translation difference is basically an exchange difference which arises from translating the items of asset, liabilities, revenue, and expenses of this foreign subsidiary into presentation currency, of which in this case we are going to see this currency translation difference or this exchange difference can either be a gain or basically a loss. Can either be a gain or a loss. Now, this particular gain or loss, we can say this arises due to translation. This arises due to translation of basically 3 items. One of which is goodwill. Is goodwill on acquisition. Number 2 is a profit for the year. A profit for the year, and number 3, the subsidiary company opening net assets. So opening net assets. opening net worth asset. So we are saying that this currency translation difference, which arises as a result of translating the items of asset, liabilities, revenue, and expenses into presentation currency, it basically arises from the translation of those three items, the translation of those three items. So I want us to look on how we determine this currency translation difference, which basically arises from translation of those three items, the goodwill, profit for the year, and the opening net asset of the subsidiary. So let's start with the goodwill. The goodwill. So remember, goodwill, this is the difference between the purchase consideration paid by the parent company and the net asset which were acquired. So basically, what is important, first of all, to note here is that when computing the goodwill, first of all, we compute the goodwill, or basically we say that goodwill is computed using the fractional currency, using the fractional. The fractional, remember, is the local currency. For example, the local currency of Kenya is Kenyan shillings. The local currency of Rwanda is Rwandan franc. So first of all, we compute the goodwill using the goodwill is computed using the fractional or the local currency of the foreign subsidiary of the foreign subsidiary. So if the foreign subsidiary is operating in Rwanda, what you do when computing the goodwill, first of all, compute the goodwill in Rwandan franc. You compute the goodwill in Rwandan franc, not in Kenyan shillings. Compute that using Rwandan franc, and then translate it. Look on how we determine this. We need to have three, like a number of columns here. So here we have. In this case, I will assume our parent company operates in Kenya, but the foreign subsidiary operates in what? In Rwanda. So here we will have now the local currency of the foreign subsidiary, assuming it is Rwandan franc. This is basically the local currency of the foreign subsidiary. We have a column here for the rate of exchange. The rate of exchange, the exchange rate between Kenyan shillings and the Rwandan franc. So here we have a column for the exchange rate, and then here we translate that into presentation currency, which is the Kenyan shilling. So here we always start with the goodwill on acquisition, the goodwill at the date of acquisition. You'll be able to see in all these particular questions for foreign subsidiary, this particular foreign subsidiary is always acquired at the start of the current year. So therefore, what we do, we compute this goodwill on the date of acquisition, which is always at the start of the current year. And I've said we compute this goodwill always using the fractional or the local currency of the foreign subsidiary. So if the subsidiary is operating in Rwanda, we will compute that goodwill using the Rwandan franc, this one. Then we translate that into Kenyan shillings using which exchange rate? The opening, O for opening, the opening exchange rate, the exchange rate at the start of the year. We get the value there. And then after this, what we do is that we less any impairment loss. This particular goodwill automatically will have impaired. So we less impairment loss here. And because this impairment loss is an expense, you have to remember what you have said here. Any item of income or any item of expense will be translated using which rate? Which rate? The average, A for average. Maybe you can just note that somewhere, A for average. And then we get now the impairment loss in what? In Kenyan shillings. So then we take this minus that. And basically, you read one line here. That now will give us the value for goodwill at the end of the year. This will be the value of goodwill at the end of the year, and that is the date we are doing our consolidation. Remember, doc is the date of consolidation. So this will be the value for the goodwill at the date of consolidation, which will be at the end of the year. Then into presentation currency, and in this case here, because it's an item of assets, and we are translating that at the end of the year. Now we have to use which exchange rate? We use the crossing exchange rate. We take this, we choose the crossing exchange rate. We take this, we translate it into presentation currency. We get the value here. the value there. Then for us to be able now to compute this exchange difference, what we do is that these two values, this and this, of which in this case we can have an increase. Maybe from this to this we can have an increase, or basically from this to this we can have what? A decrease. We can have a decrease. So that increase or decrease is what you refer as exchange difference. And this exchange difference can either be an exchange gain or an exchange what? Loss. So if basically we have an increase, maybe from here we have 80 million, but here we have 100 million, you can see we have an increase. An increase is a gain. The value for goodwill increased is a gain. An increase is a gain. But if we have a decrease like 80 million to 60 million, that is a decrease. A decrease is basically what? An exchange loss. An exchange loss. An exchange loss. Now, this particular exchange gain or loss, this one will be recognized in the consolidated income statement. In the consolidated income statement as part of other comprehensive. Recognized in the consolidated income part of other comprehensive income. So we know other comprehensive incomes. We add this to the gross profit. Not to the gross profit, sorry. We add this to the